Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the conventional conforming loan limits are here. My interview with Panorama Mortgage Group's Hector Amendola on home sales trends, borrower sentiment, rate psychology, and how originators are winning business in the current environment. And the news spigot is finally back open with the government in full swing. Let's take a look at what we can glean from recently released economic data. When I think about a point of sale, I want something that's simple, easy, and efficient. The big point of sale offers a highly configurable, easy to install point of sale solution. Their simplified consumer workflows and web-based portals allow for consumers and loan originators to collaborate with the back office team to keep everyone informed throughout the loan process. To learn more, visit thebigpos.com. The new conventional conforming loan limits are here. True, lenders that are entirely focused on non-agency products like non-QM, without many of the loan level price adjustments or G fees, may not care too much. But for most, Freddie Mac and Fannie Mae's changes are followed closely. For 2026, we're up from 2025's $806,500 to $832,750. This beats the $819,000 amount by about $13,000 that many lenders and investors moved to in late September and early October. They can all rejigger their systems now. All this focus on conventional conforming programs reminds me that LO comp is still a huge issue, and the source of litigation. It shouldn't be put on the back burner. I continue to hear that promises made to potential recruits that are in violation of LO comp rules. Who's going to research and penalize infractions? The CFPB? Ha! Lenders shouldn't have to pay the same for a conventional conforming loan as a bond program, and most agree that change is needed. LO comp rules being ignored can hurt companies. Anyways, as I said, in most of the United States, the 2026 conforming loan limit value for one-unit properties will be $832,750, an increase of $26,250 from 2025. Companies like PennyMac and AmeriHome quickly followed suit. Recall that Housing and Economic Recovery Act, or HERA, requires FHFA to adjust the enterprise's baseline conforming loan limit value each year to reflect the change in the average U.S. home price. Yesterday, FHFA published its third quarter 2025 FHA House Price Index report, which includes statistics for the increase in the average U.S. home value over the last 4 quarters. According to the nominal, seasonally adjusted expanded data FHFA HPI, house prices increased 3.26% on average between the third quarters of 2024 and 2025. Therefore, the baseline conforming loan limit will increase by the same percentage. Lenders in high-cost areas are well aware of a caveat. Namely, for areas in which 115% of the local median value exceeds the baseline conforming loan limit value, the applicable loan limit will be higher than the baseline loan limit. HERA establishes the high-cost area limit in those areas as a multiple of the area median home value while setting the ceiling at 150% of the baseline limit. Median home values generally increased in high-cost areas in 2025, which increased their CLL values. The new ceiling loan limit for one-unit properties will be $1.249 million, which is 150% of $832,750 for Alaska, Hawaii, Guam, and the U.S. Virgin Islands. The baseline loan limit and ceiling loan limit for one-unit properties will be $1.249 million and $1.873 million. Anyways, let me change up the subject here slightly. There's an age-old originator question out there. Would you trade worsening economic conditions for lower rates? We've had 4 consecutive days of rallies in the bond market, most recently because consumer confidence fell sharply in November to a 7-month low, with both present conditions and expectations weakening, while right-wing responses showed growing concern about inflation, trade, politics, and the potential government shutdown. The figure followed a more dire readout from last week when the University of Michigan showed U.S. consumer sentiment fell to one of the lowest levels on record, with views of personal finances their dimmest since the Great Recession. Meanwhile, retail sales, not adjusted for inflation, rose a tame 0.2% in September after several months of more robust spending. While consumers have pulled back on some big-ticket items, they're seeking bargains. Alongside a deeper-than-expected contraction in the Richmond Fed Manufacturing Index and a modest rise in pending home sales, Treasury yields have dipped. Per FHFA, U.S. house prices rose 2.2% year over year in the third quarter of this year, with modest quarterly and monthly gains continuing a long stretch of annual appreciation since 2012. Most states and major metro areas saw rising prices, led by the Middle Atlantic region, while Florida and parts of the Pacific Division posted the sharpest declines. Treasuries remain slightly bullish as investors wait for data that is unlikely to shift expectations already shaped by CPI and labor reports. Despite resilient consumption and mixed risk signals, the market's tone and repeated tests of the 4.0% level and 10-year Treasury yields suggest investors are ready to lean into any softer data or risk-off moves. Looking ahead, analyst consensus is for a 3.85% year-end target for 10-year yields, viewing the December 10th FOMC meeting and its updated projections as the key event that will determine whether this bullish view holds. For today's interview, I wanted to welcome back to the show Panorama Mortgage Group's Hector Amendola to talk about home sale trends, borrower sentiment, rate psychology, and how originators are winning business in today's environment. He has more than 20 years of experience in mortgage lending and is guiding the organization's strategic vision and promoting innovative solutions for first-time homebuyers and FHA programs. His goal is to help families and communities build secure financial futures through the power of homeownership.
I was looking at your bio, actually, and there's several areas of expertise. Obviously, mortgage lending is one of them, homeownership, first-time buyers, minorities, underserved communities, VA lending, HELOCs. What's really interesting you right now? What has your attention? What are you passionate about?
The number one interest for us right now is first-time home buyers. First-time home buyers, specifically, again, we serve the underserved communities, the Hispanics, the Blacks. We coined the term Black and Brown for that specifically because we want to get people's attention for it. But yeah, first-time home buyers, the fact that, the first-time home buyer age has got over 40 years old now. It used to be 31 years old. I think that's a huge problem for us as a country, really. It's going to affect people's health in the long run. It's going to affect people's wealth in the long run. And I think it's important that it gets addressed.
Yeah, how do we better serve that market? Does it come down to regulation? Is it certain underwriting guidelines freeing up ways to get creative with financing? Is it on education? Where do you think the industry can do better for these first-time buyers?
It's interesting for a lot of buyers, like Latino and Black buyers and first-generation families, the market feels a little bit out of reach for some of them. And it's not intent. I think it's structure more than anything else. But, because our credit and underwriting systems weren't built to handle our communities and the way we handle money. And so I do think that I've seen some changes that are changing with respect to minimum FICO scores and minimum trade lines that I think is going to be helpful for first-time home buyers in these communities. But I think it's overall structurally there's just a need for a Panorama Mortgage Group that understands the different types of loans that you're going to see. And we're not going to turn our nose up at, as an example, two families buying a home, right? Because I know, growing up Latino, that's pretty normal. And then we knew a lot of families that grew up with, two families in a home because that's how they can afford a home. And, with affordability being an issue, you're seeing more and more of that. And, I've also lived in a world as a loan officer where I would worry about submitting that file because I don't know which underwriter is going to get it. And I don't know how they're going to perceive that. And, breaking through some of those barriers, I think, is key to helping more first-time home buyers in underserved communities.
Yeah, let's back up a little bit from first-time home buyers to kind of the general borrower pool. How would you assess current borrower sentiment out there? And I say that with the backdrop of, sure, maybe the Fed is expected to low. This is from a general person's perspective. The Fed's lowering rates, so mortgage rates must come down. Well, that's not quite how it works, and a lot of the pricing's already been, or a lot of the expectations have already been baked in to pricing. But in general, right now, are you sensing hope and optimism? Are you sensing people kind of despair? I've heard some stories anecdotally about people's debt burdens have increased a lot, and so maybe the less people can qualify now, even if rates do drop. How would you assess kind of overall borrower profiles and sentiment out there?
I think it's better than it was. Obviously, we've come down from the peak of those interest rates, and there's more people that are willing to jump into the pool of buyers. And, it's evident by, even if it's just a marginal uptick in sales that were reported last month, it's still an uptick, right? And so it's kind of crazy how it seems, right? Whenever rates even have a small decline, our applications in November are up 15%, which is, kind of unheard of, right? Not this time of year usually, but that's happening right now. And I think it has a lot to do with the interest rate. So the psychology, I think, of the interest rate is interesting because I did loans in 2008, 9, 10, where 6% was pretty normal. And even before that. And now everybody says 6% is high because you're comparing it to 2021 or 2020 when, people were getting rates in the twos and threes. And I think it's changed people's perception of what a good rate is. That being said, it's more than rate, right? There's affordability issues because home prices have continued to go up. Even in this high rate environment, they've continued to go up. I think that's more of an issue with inventory than anything else. But the thought process out there is I can't afford it. My insurance prices are going up. Home prices are going up. Rates are high, and so it's hard to afford. So instead of doing that, let me go do something else. Let me travel. Let me spend my money elsewhere. And I think it's a problem. I think that's why people are buying homes at a later age right now. But to answer your question about if I think there's optimism. I think that as you hear rates could continue to go down, there's optimism. But I still think people are holding off and they're trying to time the market, which I think is a big problem we have.
Overall trends we're seeing in home sales. That's a really interesting stat you threw out about rate locks going up by 15% in November, when it's, historically not the time of year for it. Any other trends you're seeing out there that you find interesting? And that could be with the type of homes, it could be with certain metros, that we're seeing migration patterns. It could be in just borrower profiles, whatever. Any trends you think are worth bringing up?
I think the big one is, something that we talked about as an executive team a few months ago was, if we're going to be in the first-time home buyer market, we better be really good at doing manufactured homes, which is not something that, historically I would, say we have to be good at that because, like, I don't know, I'm not sure the interest was there before, but with just affordability being such an issue, it seems people are looking for different ways to figure out how to get into housing, and that's one. I would think that's probably a trend that I've seen up, on the rise more recently. Beyond that, I think that what happened after COVID was a lot of people started moving around and finding places that were more to their liking. Hybrid work or remote work makes that easier. And so I live in Las Vegas now. I grew up in Southern California. There's a lot of us out here. And I think that's happening throughout the country. People are finding more affordable places to live because it's possible now with remote work too.
Then when it comes to rates, I mentioned it briefly. People think the Fed are cutting rates, and yeah, that doesn't mean mortgage rates are coming down. But can you talk about borrower rate psychology right now? And I would say hopefully some of the discussion has moved away from the rate to kind of overall what can people afford, considering how expensive insurance premiums are, considering HOA fees or property tax, other things that can scuttle deals.
Yeah, so we spend a lot of time talking about that, right? If our mission is to help underserved and our mission is to help first-time home buyers, what is the real problem in front of them? And of course, the one everybody talks about is interest rates. But we're seeing these metros that are having rising insurance costs that are a problem because if you're maxing out your debt to income ratio, and then your fire insurance is going to go up and double or more than double next year, then now you have a problem with being able to make that payment. So I think rate psychology is a huge thing. I think even I peruse LinkedIn and you see a lot of mortgage professionals say rates have to come down, rates have to come down, and I agree with that. But I also think it's going to cause a different problem. I think it's going to cause an inventory issue. Our inventory numbers are still historically a little bit low, right? And I think that, when you see lower rates, what happens is all the houses go because everybody wants to buy now. And the affordability will continue to be a problem because prices will go up. And so now you add that to the fact that people have rising debt, you add that to the fact that people have rising insurance costs, and suddenly affordability is even a bigger issue. But everybody's focused on interest rates. And I always tell our loan officers, educate your borrower on the availability of your home. You're focused on interest rates because you think if I have the lowest interest rate, I want to be able to tell everybody, look at this great interest rate that I got, or whatever reasoning it is for them wanting the best rate. But really, you have to focus on your monthly payment. Number one, make sure you're focused on that. And beyond that, in a competitive market, it's hard to find the house you want. And if you have somebody who could afford a house right now, regardless of rate, don't try to time the market, try to buy your house, because what we've learned over the years when you've been in this business long enough is, I'll give a personal example. I bought my first house and it was $310,000 and my mortgage payment was um, about $3,000. Well, today it's worth a lot more and the payment's a lot lower, right? And so it's getting into the game, I think, that really, really matters to people, and people sometimes miss out on that opportunity because they're looking at trying to time the market. So the rate psychology, I think, is a big deal. I think that we don't help it as an industry because we're always talking about, oh boy, these rates are so high. And what we really need to do is educate people on rates aren't high. Can you afford the payment? If you could, get in the game because it's going to change your life.
Yeah, certainly sage advice. It's timing the market has never worked out well in a broad sense for people out there. So that's good. I want to talk about Panorama and you and what you're focused on, because obviously there's a huge tech revolution going on right now. And companies are doing everything they can to win business. They're focused on how do we generate leads, or how can we focus on recapture. When it comes to winning business for you and for Panorama, what are you doing that feels like sets you apart?
I think tech is an interesting topic because I was at a conference recently, and one of the presenters was talking about the timeline for tech and how we had just gotten past the hype part of tech, and now everybody was trying to implement whatever technology. And I disagreed with that. I'm thinking, no, we're still definitely in that hype phase when it comes to tech. And so to speak about Panorama specifically, we really shied away from tech for a couple of years. We were focused on growing our operations center that we have in Guadalajara, Mexico, and focusing on cost to manufacture in that way. And so what we would do whenever a new technology was presented to us is we would evaluate, is it actually going to improve our cost to manufacture, or do we already have that because we have less expensive labor in another country? And so that's something that we spend a lot of time building and training folks so that we can make sure that we take advantage of it. Now here we are. That's been going on we really have made some strong efforts over the last 3 years in that facility that we have in Guadalajara, Mexico. And so now we've shifted into technology, and you're right, there is so much information coming at us. There's so many people saying, try this product, try that product. And I think it's important that what we're doing is we do have a chief technology innovation officer, and he's focused on presenting the right technology and us finding it. But we're really in the infant stages when it comes to that, because we want to be really careful. We don't want to go through what we went through 3 years ago, where we were trying to get all of the technology and then trying to wind that down when things got tough was a really, really difficult thing for us to do. So I think that for us, what we're doing is we're moving really slowly on that, because we're trying to find the right technology that really helps versus just creating another implementation thing, because we're focused on change. And change management is difficult, and getting people to accept change is difficult. And it has to be done in a way where you can trust that this change worked. We got that win. Now we can move on to the next one and focus on that win. And I think that psychology for folks is more important than making sure we have all the tech we can get in house.
Yeah, I love that answer. And it's been a pleasure speaking with you today, Hector, and hopefully we'll have you back on soon. It won't be as long until the next one as it was between the first one and this one. So thank you very much.
Absolutely, man. Thanks for having me on.
Gross MBS issuance has jumped in the last few days ahead of the Thanksgiving break and has hit its highest level, $118.3 billion, since it registered $125.5 billion in August 2022. The prior high was last November's $117.8 billion. Ginnie Mae issuance accounted for 42% of the total versus 26% for Fannie Mae and 31% for Freddie Mac, compared with 40%, 28%, and 32% respectively in October. Today's calendar could include some data that was delayed due to the government shutdown, including PCE, durable goods orders, advanced indicators, and new home sales, all for October. Even as mortgage rates inched up to 6.4%, mortgage applications increased 0.2% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending November 21st, 2025. Purchase applications rose across both conventional and government programs, with the government index seeing its strongest week since 2023, even as affordability remains strained. Refinance activity fell nearly 6% as borrowers pulled back after several weeks of rising rates. We've also received durable goods orders, up 0.5%, excluding transportation, up 0.6%, and weekly jobless claims, in at 216,000, lower than expected, with 1.96 million continuing claims. After yesterday's $70 billion 5-year note sale met underwhelming demand, today's supply calendar will be headlined by $44 billion of 7-year notes. Other items of note include Freddie Mac's primary mortgage market survey and the Fed releasing the Beige Book ahead of its December 9th and 10th FOMC meeting. We begin Wednesday with agency MBS prices unchanged from Tuesday's close, the 2-year yielding 3.46 and the 10-year yielding 4.00 after closing yesterday at 4.00% in the midst of rising expectations of a December 10th Fed rate cut. Let's wrap up with a joke and some housekeeping. A Mexican politician and an American politician are having dinner. They're eating at the American politician's house, a 6-bedroom house with 2 Mercedes-Benz in the front and a 500-square-foot garden. The Mexican politician remarked how nice his house was and how he was able to afford it. The American politician replied, "See that highway over there? It was meant to have 4 lanes instead of 3. A few months later, the Mexican politician invited the American over to his house down in Mexico. When the American arrived, he saw the Mexican at a 30-bedroom mansion and a lush orchard and massive garden with bodyguards and a Lambo or Mercedes, a Porsche, and a few SUVs at the front. Awestruck, the American asked, "How could you afford all this?" To which the Mexican replied, "See that bridge there?" Confused, the American asked, "What bridge?" "Exactly," the Mexican politician said. Oh, it's a corruption joke. Uh-oh, don't cancel me. Thanks to this week's sponsor, The Big Point of Sale, which delivers a fast, flexible, and low-cost mortgage point of sale that gets lenders up and running in hours, not months, while empowering loan officers and consumers to collaborate seamlessly from any device. To learn more, visit thebigpos.com.